So today's fit is, do you want to go to war, Balake, from the Key and Peele's substitute teacher sketch? And
That's right.
the substitute teacher's over this side. So for those of you who've seen the Key and Peele's sketch, it is the substitute teacher. Do you want to go to war, Balake? Today's fit is, do you want to go to war,
You know, it's
Balake?
it's funny. I'm like, yeah. So I was like yesterday, I noticed like, yeah, the t-shirt thing going. I was like, maybe I should go Christmas jammies this morning. I was like, is that would that be appropriate? Because we can do the t-shirt. Can we do the jammies?
Yes, of course. Anything holiday is appropriate. Anything and everything holiday is appropriate. Well, Brandon, it's been a weird week as far as data goes in response. Uh, and yes, I know that there's a lot of discussion about inflation. We've talked about inflation repeatedly, and this is not your between Thanksgiving and the holiday eating inflation data. This is the inflation data as far as where your money's going and how much it costs to get there.
Yeah.
We've talked about inflation quite a bit over months, years, arguably. um, I've got the consumer price index up. I've got the producer price index up. I've got that ready to go. But one of the questions you and I were talking about before that we started was, what is inflation? I mean, we're going to get to the data, consumer price
Yeah.
index, producer price index, but what is inflation and how does this tie into some of the other things we're looking at? How would you describe inflation?
Well, I mean, here's the thing. Up until about 50, 60 years ago, we defined inflation based on the supply of money. But we've shifted. Now we've like, have this focus, this preoccupation with prices, and then there's lots of variables that may contribute to prices. But inflation is either the increase in the money supply, or if we're talking about CPI, PPI, we're talking about an increase in a basket of goods. Now, if you're wanting to know why inflation is important, is because it affects the value of the dollar, and everything you buy in the market, options, stocks, futures, are priced in dollars, and as well as apricots.
Apricots.
Are
Yeah.
those apricots there?
Well, I think it's interesting the way you put that because I say this all the time. Equities, the stock market is an inflation item. It's a thing. If we're talking about, I always say CPI or inflation data is telling us that do things cost more?
Mhm.
And it's really, do things cost more relative to the dollar? And so when we look at the information, we can get into the nitty gritty here. But it's interesting that the food, prepackaged food, which is, we don't even have the full set here, but prepackaged food apparently went up
30%.
significantly, 30 some percent. Yeah, 30 some percent
Steve
over the
Leeson's
year.
having he's like, what is this? I've never seen this
I,
before.
yeah, so if you, the great little
Interesting,
video clip,
baby.
he's saying, I was just going through all the data and this must be a misprint. It's 30 something percent. No, it's the packaged finished food. So when you're buying something that's complete, a meal, a dinner, or something that's coming to you that you're buying at the store or having shipped to you, the fact is those costs have gone up again because you have the rising costs across the board, across multiple things that are contributing to that item. But food at home
So if
up
you're wanting a
2.4%.
so if
Go
you're
ahead.
wanting a Marie Calendar like Salisbury steak for Christmas or whatever special holiday, you're paying 30% more.
Well, and that's when we can get into the discussion of substitution. Let's substitute anything instead of Salisbury steak. As these are the numbers that I would look across and look for stuff that's outliers as well. Not just that the Marie Callender's Salisbury steak dinner is at now 35% more, but we've talked about this in the main room just a little bit. Fuel oil is down 20% year over year. How many people are still using fuel oil as far as heating their homes?
Back east, I'm not sure. Like it's
I'm curious.
yeah.
And yeah, I'm curious because when we look at other
Let's throw it in
oils,
chat. I mean, throw in chat. Who uses fuel oil to heat their home? And number two, what is your favorite dinner, TV dinner? And number two, three, did you grow up having a TV on top of a TV tray? Let's complete the trifecta there.
wow,
But yeah, I don't know.
that's
I'm
a
like, is fuel oil a thing? But we've had a warmer season so far. Although we are going to have a that polar vortex or whatever come in and sweep in the east that could create maybe more demand for fuel oil, but pretty cyclical.
yeah. And I was running the numbers on it, and it's just not as highly used. Natural gas prices, which are listed as other, and energy services. This energy services, what is your energy service gas services, piped gas? That went up 3%, but the majority of the nation is actually in natural gas. They heat with natural gas, and our power facilities heat with natural gas. So
Mhm.
that's right in line with what you're supposed to be. But 20% decline in this would make it look like we're seeing deflationary pressure in energy. And
Yeah.
from a year ago, yeah, I could argue that. Scroll down here. This is interesting to me as well, because, oops, I highlighted the commodity, less food and energy. So
Yeah.
basically new vehicles and used cars are the ones that drop. Here's the thing. If you are being strapped for cash, if you are being leveraged up, if you have a higher cost, are you still going to buy a car?
It's gonna be hard. The average age of a vehicle right now is crazy.
Yeah, what does it, if the prices come down in a new car or used car and you don't have enough money to eat because your Marie Callender's Salisbury steak costs more, it doesn't matter. So I don't like these ideas that these things that it's not even a matter of substitution. I always talk about a steak versus hamburger.
Yeah.
CPI data does not reflect the idea that I stopped buying steak at $8 a pound and started buying hamburger at 5. Okay, it does not show that substitution. So it looks like there's no demand and the prices aren't rising for steak because we stopped buying it.
Yeah.
Well, new and used vehicles, having that weight in here, having the fact that deflationary pressures in fuel oil are there, that's not reflective of what is happening to the consumer.
Hmm.
New and used cars, if we don't have the money, we just don't buy a new car. We don't buy a used car. That demand drops, and it looks like its prices are dropping even further in the car area. But reality is, it's not reflective of inflation. It just brings this number down, the total number down, artificially, just because we're not buying it. It stopped being purchased. So if it gets bad enough, think about stagflation type of situation. If it gets bad enough, we stop buying all sorts of things. It's not, and again,
Yeah.
substitute in and just stop buying. And these numbers will keep going down because no one's selling new and used cars. They're going to say, well, then I'll give it to you for 10% off, 15% off,
Yeah.
20% off. And those numbers can keep dropping and it'll look like inflation's taken care of.
Yeah. And that's the thing is, there's a supply. So we can say here's cars, and then we can think about, well, what about homes? Our home price is going to drop similarly. There is this supply element, right? If you have
Yeah.
more supply coming on, more use people are selling their cars, dealerships trying to sell their cars. Nissan's in trouble right now.
Yeah.
The number of car. I was looking at the Audi A3. I was thinking it was the Audi. I think it was the A3 has like 900 and something days of inventory. I'm like,
Wow. Wow.
there's some backlog here in the auto market. Toyota is still in a great shape in terms of their supplies are still tight. And so, this is becoming a more competitive environment. And again, you're going to start to see more fallout. And this is the thing looking forward. There's going to be consolidation. And we'll talk a little bit about cryptocurrency. I remember looking at cryptocurrency, writing a newsletter for a year back in 17 and in early 18. And I'm like, I remember going back to my watch list. Dude, I'm like 30-40% of those are gone. Don't even exist anymore.
They don't even exist. Yep.
And so, this is where, you just got to be more discriminating, just like your taste for holiday, going from the Salisbury steak. Maybe you do, as someone suggested, make something at home.
Yeah.
Scrap the dinner. So the idea is you got to be more discriminating in this kind of environment.
And the food away from home, I guess people are, I would argue this is probably an indication that people are now eating at home.
Yeah.
They're going out less because they can't afford it. I'm for crying out loud. I took my son for his birthday this week to dinner, and for 5 people, we were $140,000, $140,
What are you eating?
$140,000, $140. Couple of
Yeah.
appetizers, main meal, nice restaurant, 140
Well,
bucks.
I'm trying to nix this from my diet, but I'll go get a McDonald's breakfast
You need
and
to nix
using the
that.
app in Utah,
RFK Jr.
465.
and I agree. You should nix that,
Using the app in California, it was like almost $8 for a sausage, egg McMuffin, hash brown, and a drink.
which used to be $3.
Yeah. Well, and I've given up Coke. I'm now going to Monster Beverage.
You giving up Coke, you're now going to meth. Anyway, so let's
I'm Breaking Bad, Blake. Come on.
that's right. You're continuing that. But the fact is, the inflation data is there's more than just simply looking at that top line number. And the fact is, even if we were just looking at just the top line number, and if we go into producer price index, which was even more so, here's the numbers here, producer price index here, we can say, hey, look, where are we at? Where's my line? Oh, am I on the wrong line? Producer price index. Scroll down. We were even hotter here. We're 0.4% increasing again, and 3.5% year over year, less food and energy, 3.5 and 3% here. So PPI, producer price index, which producers either take a hit and we see it in earnings, so the companies struggle, or they pass it on to consumers. And so this is a forward-looking indicator to tell you either consumers are going to pay more because it's going up again, or you're going to see a hit to earnings. That's your choice, or a little bit of both. Any comments there on producer price index before I want to get into.
Yeah, I mean, yeah, I think you stated it right. It's the pipeline, right? So we're saying, okay, we're feeling it now, but down the road in the pipeline, there's this inflation coming. And again, like you said, the important point is either it's going to erode profits or it's going to erode our purchasing power. And so yesterday I walked through how to use AI, doing some fundamental research. And one of the questions we walked through is asking about inflation. And it was kind of interesting that ChatGPT brought back, okay, here's the impact of inflation on specific sectors. These are a handful of companies that discussed inflation in their most recent earnings report. And so you can use, again, some of the stuff that's easy to pull using an AI tool or engine, what do you want to call it?
Yeah, and I think we forget all the other things because there's all the things that are being impacted by inflation, that process, like you're saying, that ChatGPT picks up on. And one of the things that you asked to talk about, I've listed average hourly earnings. If consumers are going to get paid more so that the inflation doesn't hurt them, that causes inflation. And so I've listed average hourly earnings, which is also rising, producer price index and average hourly earnings. But you also listed the idea of affordability. So I think this ties to average hourly earnings, and housing is part of inflation. So can we afford anything, but can we afford houses?
Yeah, I mean, and this is the thing is, I'm like, inventories are pretty low in the housing space. But the idea is this is also a reflection of disposable income. And I'm looking at Utah, 49% of household income is being used for mortgage payment. And I'm like, we have one of the highest median prices for homes in the West, along with Oregon, Washington, California, Arizona. And I'm looking at Iowa and Ohio. I'm like, man, Blake, we could live anywhere. Why not Iowa? Why not Ohio? Go back to my the Chapman roots in the east in Gallia County, Ohio, on the Ohio River. I'm like, it's too cold, man. Like if
Yeah,
humidity.
it does gonna say besides being too cold, super cool houses in like Cincinnati area, but I would never live in Cincinnati. I've
Yeah.
traveled to every state in this country, and Cincinnati's cool old buildings, but yeah, too cold. And no, no offense to
My
anyone that
great
lives in
grandfather
Cincinnati.
was a river, share kind of a again a law enforcement official on the Ohio River in Green Bottom, West Virginia.
West Virginia Mountain Mama.
Yeah.
Is there a road? Take me home.
Yep.
Yeah, and I thought this is interesting. 68% for Montana. So even though Montana's house price is not anywhere near what Utah, Oregon's are as far as average house, it shows you that their price of their house is relatively higher to the income. So the income is way lower, even though the prices are not higher. And so as we're looking across the board, this, like you're saying, that Montana 68%. Yeah, this is compared to its affordability photo guy. It's not just the total housing price. So Utah's in the top three. Theoretically, like Brandon said, we could sell our very expensive houses because they're in the top three in the country and move to Ohio, where our income theoretically would not change, or Iowa. But yeah, I'm looking down here and saying, well, let's maybe not go into the green, but let's maybe go into this light pink. Louisiana, yeah. South Carolina, good
Yeah.
barbecue. Yeah. So
My sister-in-law and my brother-in-law, they moved to Arkansas from California. That was a decent change other than here in Arkansas,
it's Arkansas.
Bentonville.
Um, yeah. So Vicky brings up her homeowners insurance and auto insurance are all going up. Yeah, and
Yeah.
they're insuring the rebuild of your home, assuming they pay it out, if something happens to it. And I always think it's funny, after you have your home paid off, you end up still paying a percent a year on your homeowner's insurance and taxes in
Taxes,
many
yeah.
areas. Yeah. So you're never really free and clear. And as far as we're watching these rate changes and the impact of the rate changes, we had rate cuts and more cuts and more cuts. What's happened with our interest rates? What's happened with the borrowing rates? You know, as we're looking at this, let's go and pull up this. Oh, wrong chart. Brandon, this is your chart. Let me pull up this while
Yeah.
you're.
So I know this is something you mentioned quite a bit as far as like, oh, what does it cost for a specific mortgage rate? And so again, the bottom line is we're being stretched in a lot of different areas. And when you think about market prices, historically market prices, real estate, stocks have been very correlated to wages, and we're seeing wage stagnation. But now it's more focused on the ability to continue to go further in debt, and that's stretched. So we have all these areas that are very, very stretched in terms of the consumer debt and wages not going as far. And how does that reflect on equity prices? How does it reflect on the market? And the very extreme optimism for 2025. I'm like, right now, we have two 20+% years in a row, and the forecasts for 2025 are really above trend this coming year.
Well, and that,
Market
let me just,
returns.
yeah. So throwing back on that TNX chart, the TNX 10-year Treasury yield, I always can tell you that take this number, 4.3, and add on 2%. That's it. So 6.3%. So Brandon's got this little chart here. We're talking about right here anyway. So the 30-year mortgage rate, yeah, it's right where we would thought. And so this is significant. The fact is we are being stretched to the extreme.
Yeah.
And you know, my son who wants to buy a house and has saved and saved and saved and has a lot of savings, and he's looking at this and says, I can't buy a condo that I can afford, even though I make good money and have a huge down payment. It's ridiculous. And rents are actually behind as percentage of income compared to other areas in Utah as well. So people are still renting. So it's
I
just
know, I
super
know in your
fascinating
neck
to
of
me.
woods, I'm like, my wife's cousin, I'm like, they bought a townhome, like, this is like a couple years ago,
Mhm.
500,000 bucks. I'm like, for a townhome
For a
in,
townhome. Yeah.
in Westlake, Utah. Are Lakeview is that important?
Yes.
Okay.
And so that's the reason why I haven't moved yet. That's why I don't live in Cincinnati, Ohio, is because I need my Lakeview. Um, and there's some truth to that. But the question that I think kind of circulates, you're talking about equities, and we're looking at another 20% year next year in 2025 as far as projections go. That's inflationary. Bitcoin, crypto, and everything else like that. Does that mean these are inflationary as well? Is this enough of an asset, enough of a thing, as I commented just a minute ago, to call inflation or the move in Bitcoin? I'm just going to use BTC here for us. Is
Hmm.
this move in Bitcoin inflation? What do you think, Brandon?
From my perspective, there is a degree of speculation. So BTC is a paper asset. This is not Bitcoin. This is a paper
Right.
reflection of, so you can have speculation that can drive prices. But what it is in part a reflection of an expectation that the dollar is going to devalue if Bitcoin's going to go higher, if gold's going to go higher. It's the money supply's got to expand. And that's the real question, that we may deal with higher prices because of government spending and other decisions, but may not necessarily see the dollar devalue at the same rate we have the last few years. That's eroded the real return of the market. And so this year looks fantastic when you put it in real terms. The market didn't make any money this year. The purchasing power of your S&P shares, if you bought at the end of December and you sell them today, doesn't buy any more goods than it did at the end of 2023.
And this is not the exact representation, but you could do that a little bit by just taking ES and
Yeah.
subtracting gold off of there and saying, did we really make that kind of return? And one of the tricky things I think is I don't know if you got used to get this when we were at the education arm over there at TD Ameritrade Investor's days of, and people would say, well, I want to buy the dollar. I want to sell the dollar. And I'd say, okay, what do you want? Well, I just want to sell the dollar.
Yeah. Well, what's the dollar, right? And I
Yeah.
asked this question on Wednesday. It's like
So when people say
you
that
have
the
to compare
dollar
it
is
against
getting
something.
stronger or weaker, if we're talking inflation in dollar terms, what is the dollar? Well, the dollar index is the dollar compared to other currencies. Gold is the dollar in gold terms. So when we're talking about the dollar strength and weakness, this is the dollar in gold terms.
And gold fluctuates less in value, not price, but value than the euro.
Right.
So that's why if you really want to gauge the value of the dollar rather than the relative price, gold's a good asset to do that.
Right. Yeah. And this down here at the bottom, just really quickly before we continue on here, this is what I've commented before. It's probably one of the best, in my view, technical indicators of inflation. It is just comparing gold to the equity market in a price specific setup. And even better than that is the risk-free premium by comparing gold to bonds. And there's a lot of data on this. There's studies that you can do in this. And again, we're kind of cheating by using just gold futures versus bond futures. But this is what's comparing the risk-free premium, because they still call bonds a risk-free premium of gold versus that risk-free premium. And so this is one of the highest inflationary bits of data that we have. We can see that we have gone higher and higher and higher. So compared to the risk-free premium of bonds, we're still way high as far as inflation is concerned. And just from 2023, we've gone from a measurement of 16 to 24, which is an additional 50% change in the ratio. And so when we're talking about inflation climbing, you say, well, we didn't climb 50%. It's like true, 50% compared to the ratio it was last year. And so from 2023 to 2024, we're going 2 years here. And in 2 years, let's say that we had 10% inflation. We've gone another 5% in that 2 years is what that's really telling us here.
Yeah.
And this is one of my favorite indicators because you can see from a week to week basis, and I would say slow it down to weeks or months, but you can do it daily as well. We're consolidating, but we're not going lower. And the Fed is going to do what next week?
They're going to cut 90
They're
plus
going to
percent,
cut.
right?
It's 90. I think yesterday we finished at 94% probability.
Mm-hmm.
So we had high inflation data. Inflation data saying what's still going up. And I saw the professor commenting on the fact that eggs are 96%. The eggs and beef were at record highs. And he's saying that Jay Powell is saying, oh, we're fine, right? And he's, of course, mocking Jay Powell, but
Well,
as
Janet
he
Yellen
should.
did express a little bit of regret they didn't do enough on deficits. Like, what was it, $367 billion last month in deficits?
Amazing.
Yeah.
And we're still going to cut rates, just to
I'm
be
still
clear.
going to cover it.
Yeah, still going to cut rates. And what's going to happen if they cut rates another 25 basis points? More inflation. It's just it's a foregone conclusion. So
I mean,
this number, the indication, go ahead.
this is where like I get, it's like because if the Fed they're still trying to reduce the size of their balance sheet and at the same time cut rates.
Mm-hmm.
It's kind of an oxymoron, right? Just like we're raising rates and we're expanding our balance sheet or maintaining all these facilities, it's like we're trying to have our cake and eat it too. And so it's like, and we're seeing massive government spending, which ostensibly may curtail next year. So like I see the price side of it, but part of me is like, I mean, are we about to see the dollar increase, or does the policy on the tariff side cause people to sell dollars, which is going to weaken the dollar, cause price? There's just a lot of just uncertainty as to, what stuff's going to do next year, and I'm just not so certain. We know, but certainly we've had a very inflationary trend for a while.
Yeah. Well, and again, if we're using this as an instrument, a gauge of that,
Uh-huh.
where it's just mathematical and technical.
I mean, it's been a disaster. I mean, unmitigated, right? In terms
Yeah.
of policies over the last, again, like going back to 16 here, but going back further, we had that mini bear in 15, 16, and that stuff was kind of pulling back there a little bit, then starting to ramp back up again.
Yeah. And comparatively, again, whatever interest rate dollar purchasing power was here in 2016, we've gone from 8 to 24.
Yeah.
So if that was a 5% rate and we've gone from 8 to 24, and it was closer to probably 3, but that means that we've net multiplied that by 3 times.
And right now, I mean, Goldman's saying that next year, despite the fact they're pricing in 1.25% in terms of rate cuts, and I don't know the duration of that, they're expecting essentially for mortgage rates to stay the same in the
Yeah.
6% plus range, which means the 10-year, they're expecting it to yields to remain similar, even though the Fed is cutting. So yeah, we'll normalize the yield curve, but we're steepening it as well. And that's
Well, they cut
causing
here.
short-term rates to drop, long-term rates to remain high.
They cut in September.
Yeah.
So they cut in September and it didn't even stay where it's at. It went up. And so that means the consumer gets no relief. Cutting rates is not doing anything, even besides creating more inflation. It's not doing anything to help the consumer.
Yeah.
So not good, Robert Frost. So as we're looking at that, I think Bitcoin is speculative, like you're saying, more than just flat out inflationary. Now we've got a lot of stocks here. If there's other things people want to talk about or have us look at, we'll try to fit it in. But we've got a list: Bullish, Procter Gamble, Pepsi, Upstart. Upstarts could go either way for me. Adobe, Bohr, KHC, Moe's, Bearish Crowd, Nvidia, FXI, which is big, large cap Chinese stocks, XHB Home Builders, Jets, the regional airlines, Lennar, and First Solar. Let me go through, pull up some charts here for you. Which one would you like to lean out with first, Brandon?
Let's go defensive. What's your which defensive you want to pick?
Oh, hang on. I just lost my chart. What's my which one update?
Let's go defensive first.
Defensive PG. So PG, I like to pull back here in the middle. And the fact is I've been talking over the last couple of weeks about return on invested capital, free cash flow. And then this last week, I've been talking about operating margins or return on sales. And I started looking for anybody that had positive return on sales or operating margins and started saying, okay, so which ones are now priced well, not at their peak, but priced well. And Procter Gamble is one that came in here as a setup, middle of the channel, kind of bouncing off this area through here. I like this one on the way up, and that
Mhm.
Pepsi and Coke look pretty good as well as far as being discounted, while also being one of the ones that are showing that we are consistently positive on return on sales. And so those are the as far as in that area of defensive stocks and sectors for me. And Upstart, like I said, I could go either way on this. I'm seeing this failure. It's trying desperately to
Uh,
keep going higher, but it does set us up for a pure price pattern. I'm going to lean into it on bullish.
and Upstart's one of those one where if you're watching option activity, so I call these like pre-move pulses. It's
Mhm.
one of my pre-move pulses option activity. Upstart really picks up. Um, Upstart really starts to pick up when you're starting to see that short squeeze going on, right? We flip to high beta. They have a
Mhm.
lot of shorts. They have option activity picks up, and you get that gamma squeeze or short squeeze. So when you see the big moves like it's experienced, this is really about that kind of gamma squeeze to short squeeze where the shorts buy the stock back, they get squeezed, and the stock pops. So that's why you have such big potential in some of these stocks like Upstart, especially when you see that call activity pick up. Adobe did pretty well.
Yeah. Um, Adobe
Or not.
well, no, it's a Adobe got slammed down. This is why this is on my list as a buy it cheap.
Yeah.
But because they look at their earnings outperformed dramatically and they got slammed down. So,
And for some reason that happened. I mean, if I remember like about 5 years ago, Five Below, and the sucker just gapped hard.
mhm.
But you're like, where's the beef here, right? Or where's the lack of beef? I mean, I'm like, and it recovered. I mean, it closed that gap and
Yeah.
then started to run. Sometimes
That,
you have these just anomalous, just selling events on earnings.
yeah, and this is why this has made it to my bullish list. I think this is deeply discounted on guidance or what the market priced in. And great earnings, great profit, great returns, solid company. And so I like this. And Wally, I love the idea of selling puts on it because the implied volatility is high because people are panicking because of the move.
Yeah.
And you're probably getting a 3% short put at support or at after the earnings. And so you might get 3% to get paid to buy it here. And it's a good trade. I think it's a really good trade on that one. Um, you and I both talked about Heinz.
Yeah.
And this is also, by the way, one that has a return on sales and strong operating margins. And they're deeply discounted. You have this on your bullish list.
Yeah, I mean, this is one again, like we're, last I talked about some call activity on KHC. Is yet to break out really, but we're basing down here. And again, the yield story is good. I'm like, you have maybe $38 on the upside. You got a yield. I mean, you don't get a dividend for 3 months, but I mean, there's a lot of stuff to like here. Again, defensive, the market. I'm looking at a 5 to 10% correction, pretty decent probability of that in the coming weeks. Um, this is defensive. It's down. Stuff that's been sold sometimes goes up as the market goes down. And so that's
Yeah.
where I kind of like these positions. If you look at Pepsi, KHC, Bohr, Mosaic, big on balance
Yeah.
line divergence there.
Mondelez, Mosaic, all of these are setting up for these discounted opportunities to go bullish on these as well. Um, yeah, not a short put squeeze. I wouldn't say that Adobe is a short put squeeze. I would just simply just say it's a good short put. Just sell the put, get assigned, own the Adobe cheap. Just some one of the comments. Um, do we want to look bearish? I mean, we've got 3 minutes here before we got to pass the baton
Let's look
to.
bear.
Let's look bearish. So crowd, Nvidia. I have Nvidia short, but I'm going to focus
You're
on
laying it out there,
FXI.
Blake.
I know I'm going aggressive. So crowd and Nvidia. I'm just going to highlight crowd really quickly. I won't spend my time on Nvidia, but I want to go right through here. This looks like consolidation, failing to break to the high, purely from a technical play. Lower highs, overinflated. I think this failure to break here is a good short, and I'm going to look to sell a call vertical up here. A little aggressive on this one. So I'm being bold on that one. But part of that as well is when we're talking about inflation, the Chinese large cap gapped up again right to the previous resistance,
Yeah.
and then you can see it's pulled back again. We've done this before. This is same story, but
This
they
is
have
this is
deflation in PPI.
Yeah, and this is one that back at the lows around the 25th of November, and I talked about on my Monday video, there was big time call activity in K-Web, for example. And we put on spreads on that, call spreads because of the positive skew, great pricing, and you get that gap. You don't look a gift horse in the mouth, you close it out. It was 123% trade on K-Web, and then the next day, boom, it's gone.
Yep.
Right. So I mean, this is again, there's just this constant just rotation that's going on right now. It's just churning, and unfortunately, it may just churn your account. And also, you're just like losing after lose because you're behind the curve. Just trying to get ahead of it a little bit.
Yeah, we did a trade in deep currents on Micron, and it went up, down, and these are 3 to 8 point swings, right through here.
Yeah.
3 to 8 point swings every other day. Crazy moves and that's what you're seeing, like as you said, in Chinese stocks. You want home builders, Jets, Lennar? What do you want?
Well, so XHB is just jumping. Don sent out alert this week on an in out for lows, and the next day got out at 30% yesterday. But Lennar, it's probably more of like we talked about being bearish last week on XHB, but Lennar's one that you're breaking your one moving average, that 200 moving
Yep.
average. We're breaking support. I mean, right now Goldman's expecting sales to be in like 24% next year, I believe. So the idea is that this is not, while home prices may not fall, may not, I don't know, but sales are going to be sluggish if interest rates remain high, and this is not great for home builders. So we're kind of shorting into that kind of low point here, but this is one to keep tabs on. But just the downside's real and could last for a while.
Yeah, and we're going to wrap it up here, but I would just comment as well. Take the time to do the things that Brandon and I have talked about this last couple of weeks, and look a little bit into their fundamentals, because Toll Brothers, D.R. Horton, Pulte Homes, Lennar, KBH, all these companies, if they're going to see a slowdown in demand, look at their quick ratio to see, do they have to sell inventory to survive? Look at their margins. Look to see which ones are fading. Take a few seconds. It's going to put the odds in your favor. Or you do like Brandon said and use AI to go and determine, let it do some of the research by saying,
Yeah.
tell me which one of the ratios are working the best and which ones are going to struggle if sales go lower. Ask it. Do the questions. Brandon, I think it's a great idea that you've been working on this week. So awesome.
And Blake, the shirts are epic.
Thanks. There's more to come. We got another 6 or 7 days. So
You got to join Blake every day.
that's right. A new
What
fit every
shirt is
day.
next?
Oh, you wait and see. It's a good one. I already
Is
know
there
which one
another
I'm
Key and
wearing.
Peele one in the works?
I do not have any other Key and Peele ones, but
Is there kind of a slap? Anyway,
I need to get one of like this with a Christmas holiday Vegas or Lampoon's Christmas Vacation. So, all right, Brandon, thank you, everybody. Have a wonderful day. Don is coming up next on the main channel in the Theo Trade main room, and otherwise, we'll talk to you again next week.
See you, folks. Thanks, Blake.
Thanks.